Hi there. My name is Victor Ali, and I'm the head of investment strategy at Sankore Global Investments. And this is your weekly financial markets roundoff. We start off as usual in the US, where the markets closed low on Friday, as the news that Trump's aggressive tariffs against major US trading partners would kick in over the weekend. The S&P lost 0.5%, the Dow was down 0.75%, while the Nasdaq slipped 0.28%. Well, I'd seen a bit of a respite, particularly in the aftermath of Donald Trump's, inauguration. Where there was the sentiment that the whole tariff thing could be delayed. However, alas, we saw that come through towards the end of last week. So the Trump administration will be leveling a tariff of 25% on Canada and Mexico, alongside a 10% tariff, on China. Now, in the aftermath of that, we've seen a really strong retaliation from Canada, sorry. Mexico has also vowed, to basically tour the same path of retaliation, while China is, basically writing a petition to the WTO or instituting a suit against the US at, the WTO. I mean, these are early days yet, but it really still remains to be seen how things pan out here. I mean, the US does trades worth about 1.6 trillion yearly with these three nations. So this is huge, and this is significant. Also put into consideration that Canada and Mexico, for instance, are essentially you might call them US allies, really. So this sort of tariff move would have very, very significant implications for the global economy. And we're seeing the market already sort of reeling, in the aftermath of, the announcements, so that's something that is really, really going to be front and center over the next, couple of weeks, in a week that, can be described as tumultuous. Last week now, the S&P lost 1% for the week. The Dow was down 0.3%, while the Nasdaq lost 1.6%. The week started with the whole DeepSeek situation, upstaging, big tech giants, really, tech titans, particularly in the US. It raised questions around how cost effective they've been, and this created a significant reduction, if you will, as far as investors are concerned, in the valuation for these companies. Created a serious rout, in the market last week. And when it seemed like the market was starting to recover, the whole tariff situation also hit. In spite of the rocky week, January still ended up positive for, the three major indices. The S&P added 2.7%, the Nasdaq advanced 1.6%, while the Dow jumped quite significantly, added 4.7%, for the month. Also, last week we saw PCE data coming on Friday. That's the Fed's preferred gauge for inflation. It came in on Friday, essentially in line with expectations at 2.6% year on year. This was, however, higher than the 2.4% that we are seeing, in the previous month. And this sort of re-echoed concerns around the fact that inflation really remains, sticky. We also saw Q4 GDP coming at 2.3% annualized, for Q4. Full year GDP came in at 2.8% compared to the 2.9% that we had seen in 2023. Going into this week, really, traders will still be looking to what you might describe as the biggest week for Q4 earnings. More than 120 companies on the S&P are slated to report their earnings this week, including the likes of Amazon, Palantir, Alphabet. So, this could prove also very, very crucial in terms of near-term investor sentiment. But make no mistakes, this whole tariff situation will certainly be front and center. I would also be looking to see non-farm payrolls for January. That should be out on Friday. Economists are expecting about 175,000 jobs would be added or have been added in January. Again, it remains to be seen, what that number would actually be. So really, this week, the US market will be, looking to further digest the Trump tariffs, the sort of retaliation that we're going to see, the impact that it might have on inflation, and really by extension, global growth. And that will certainly be sort of priced into the market, whilst earnings could provide some succor as we have some major companies looking to release their earnings for Q4 this week. Over in Europe, the ECB cut, rates for that at its last meeting. That was held last week. This was essentially its fifth rate cut since last June, cut by about 25 basis points. I think the key issue here is that The ECB is really grappling with juggling a reacceleration in inflation in the euro area with very sluggish growth, in the region. Inflation rose for a fourth consecutive month to 2.5% in January, after we had seen a bit of a respite towards Q3 of last year, but we've seen a really strong resurgence in inflation. While preliminary data really shows that the eurozone economy flatlined in Q4 of 2024. The expectation was that we're going to see about a 0.1% growth, following the 0.4% expansion that we had seen, in Q3 of last year. I mean, the ECB expects that, growth in the euro area will remain weak, at least in the near term. So the potential really that the ECB will continue to sort of cut rates to try and really keep the economy afloat is really there, whilst it also continues to worry about the resurgence that we are seeing in inflation. Over in Nigeria, for the fixed income market, really, if you look at it for the month, we really started the month on a really sort of calm note. Particularly, investors were basically looking to see the outcome of the first NCB auction of the year to basically set the tone, if you will. But I mean, we saw quite some demand early on in the year as investors looked to, sort of lock in, what you might describe as very attractive rates. We also saw, unmet bids essentially filtered through into the secondary market and created some sort of strong demand in the market. And that saw, Treasury bill yield sort of come off a bit earlier on in the month. We had two auctions in the month, offering a total of a little over 1 trillion across the three maturities. We saw the last auction oversubscribed by about 2 trillion. The DMO oversold by about 226 billion. Stop rates really remained unchanged. However, on the 1-year paper, we saw stop rates decline by about 82 basis points. Also, again, sort of reflecting the sort of strong demand that we had seen, in the market. For the bond market, also started the month sort of quietly. Traders were essentially looking out for the auction calendar to get a sense of, what the government is basically looking to borrow, to also sort of help set the tone, for the month, for the bond market. We saw quite a lot of activity at the mid end of the curve, really. We also saw, the bond auction, where the DMO sold about 450 billion offered rather 450 billion across the three maturities, but there was an oversubscription of about 219 billion, but the DMO oversold by about 156 billion. The stop rates on, the new 2035s, that's the new 10-year, closed at 22.6. Just continuing to reflect, if you will, the sort of bearish, sentiment towards the bond market, which is really hinged on the significant deficit that the government is having to deal with this year, which is almost about half of that budget. So that's creating concerns and also creating this sort of bearish sentiment in the mind of investors. And that's why we're seeing, yields, bond yields just continuing to kind of tick higher even at the auction. And secondary market sentiment really remains, weak. And the expectation is that we could see, bond, yields sort of even go higher from where we're at now, just on the back of the very significant deficit that the government is having to, grapple with, this year. So, yeah, that's pretty much it. For the global market, all eyes really would be on the whole tariff situation, how countries are reacting and retaliating, what the inflationary impact is likely to be and what the impact on growth, could be. I'll also be looking at earnings as well and some data coming out from the US. For our local market this week, again, it was just to, focus on what's happening on the fixed income side, how sentiment will continue to play out, particularly on the bond market with respect to the deficit that the government is going to have to grapple with, for this year, really. That's pretty much it. Thank you very much for your time. We hope that you have a very productive week. Thank you.